Ladies and gentlemen, good day and welcome to CIE Automotive India Limited Q1 CY24 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vasudev Banerjee. Thank you and over to you, sir.
Thanks, Steve. Good afternoon, good morning to the participants as per their location, and thanks to management of CIE Automotive India Limited for giving us the opportunity to host the call. We have with us Mr. Ander Alvarez, CEO, Mr. K. Jayaprakash, CFO, Mr. Vikas Sinha, Senior VP Strategy, and Mr. Auroj Lafoin, Business Controller, representing the senior management. Without wasting any time, over to the management for their initial comments. Thanks.
Yeah, thanks, Vasudev. I hope I am audible.
Yes, sir.
Good day, friends. I welcome all of you on this call, as also Ander Aranatsa, our CEO. We are going to talk about CIE India results for Q1 C24. We follow the calendar year, so the first quarter of calendar year 2024. At the outset, we would like to mention that Bilforge Mexico, that is BF Mexico, is now a subsidiary of CIE Galfor post the equity infusion in BF Mexico done by CIE Galfor. Please note this slight change in the legal structure. Now we start with the business results of the India operations of CIE India for Q1 C24, which are on page 7 of the uploaded presentation. Sales grew by 6% to rupees 14,388 million versus Q1 C23. In this quarter, the EBITDA of the Indian operations was rupees 2,684 million, EBIT rupees 2,126 million, and EBT 2,053 million. While sales grew by 6% year-on-year, EBITDA grew by 18%, EBIT 24%, and EBT 25% in the India operations year-on-year versus Q1 C23. EBITDA margin in Q1 C24 was at 18.7%, but this includes a one-off subsidy benefit in our aluminium business. Without that subsidy, the recurrent EBITDA margin in the India business for Q1 C24 is 17.2%, which is higher both year-on-year and sequentially versus 16.7% in Q1 C23 and 16.5% in Q4 C23. The market scenario in India in Q1 C24 was mixed. The light vehicles and two-wheeler production have grown, but the tractor and MHCV markets have shrunk in this quarter. The two-wheeler market has shown good growth on the back of recovering rural and suburban demand, and we expect this trend to continue. Light vehicles are expected to continue growing at a steady rate. We also expect the tractor market to recover slightly in the second half of the year. In our earlier calls, we had talked about some of our new orders, especially in the EV space, being delayed. We expect these to start ramping up in the second half of CY24. The results of the European operation of CIE India for Q1 C24 are on page 8. We recorded sales of rupees 8,941 million, which represents a drop of 7% year-on-year. It is pertinent to note that Q1 C23 was an exceptional quarter in terms of sales, with pent-up demand driving up sales in the European light vehicles market. The higher base of Q1 C23 has contributed to the sales drop year-on-year. If one looks at sequential growth, sales in Q1 C24 grew by 22% versus Q4 C23. In Q1 C24, the EBITDA margin in our European operations was rupees 1,435 million, EBIT rupees 1,130 million, and EBT rupees 986 million, which meant an EBITDA margin of 16%, EBIT of 12.6%, and EBT of 11%. The EBITDA margin in the European operations in Q1 C24 was adversely affected by lower sales and also because of stock reduction. This stock reduction took place because of Easter holidays falling in the first quarter of this year, while last year it was in the second quarter. So that effect on margin is there. The European light vehicle market has degrown by 3% in Q1 C24 after a period of high growth of 13% in 2023. These trends are expected to continue, with IHS forecasting European light vehicle production in 2024 to be 2% lower than in 2023. The slowdown in the US construction equipment market continues and is expected to start picking up towards the end of the year. Sales at Metal Castello will thus be adversely affected in this calendar year. And now if we go to page 9, we'll see the consolidated results. In Q1 C24, CIE India on a consolidated basis achieved sales of rupees 23,329 million, EBITDA of 4,119 million at a margin of 17.7%, EBIT of rupees 3,255 million at 14%, and EBT of rupees 3,039 million at 13%. The margins have increased on both a year-on-year and sequential basis. These are the highest quarterly margins that CIE India has achieved on a consolidated basis, and these margins are now aligning quite well with CIE ratios globally. In closing, we would like to state that we continue to focus on growth and growing with our customers so that we can take advantage of all opportunities that come our way. And now we can proceed to Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Accounted in the India financials. That's a correct understanding, right?
Jinesh, I think you just got cut off in the initial part. Can you repeat your question, please?
The Mexico business still continues to be reported in the India business, India financials, right? It's not in reclassified in Europe.
Yes.
Okay. And secondly, the 22 crores of grant for the prior period for Aurangabad Electric, that is accounted in other income or is part of other operating income?
Other income, Jinesh.
Other income. Got it. And coming to the European business, so how was the decline on euro basis? I mean, rupee basis, obviously there is a 7%. Would euro basis be close to 11% or so?
And the question is, what is the decline in Europe on a euro basis without taking into account forex in this quarter?
It is about 2% drop.
Yes, the forex impact has been a 2% of positive impact.
Yes.
So we used to reduce 2%.
Yes, the forex impact is plus 2%. That is the impact that we had. But on the other hand, we also had the negative impact of the raw material price decrease. Okay, the steel price decreased, and the impact of this decrease is approximately also 2%. So both effects are compensated, so are balanced. So we can say that the figures that you see are in line with the rupees values.
Got it. And for Metal Castello, now what's the run rate of revenues they're doing? I mean, this effectively would be the third quarter of decline. So are we now well below 60 million euros, or we are holding on to that run rate?
Okay, in Metal Castello, we had since, let's say, the second half of the last year, we saw an important decline on the sales, especially because of the American US market of road vehicles drop. This is, as you know, this is a cyclical business, and we are now in the bottom side of the cycle, especially because of the elections that are happening in the US at the end of this year. Okay, during this period, all the investments, big investments in earth moving activities and mining and so on are let's say slowed down and reduced, and we expect this to recover at the end of this year or beginning next year. Okay, during these quarters, what we have done is we have reduced our expenses. We have reduced the let's say the contract labors, and we have aligned the company to the new sales scenario, and we are selling now at approximately 5 million euros per month. This is about between 50 and 60 million euros this year, instead of the 75, 80 million we were at the beginning of last year.
Got it. A few more questions. Yeah, sorry.
Yes. So, yes. Go on, please.
Yeah. So I have one more question before I fall back in queue. So the European PV business is clearly witnessing a relatively slower pace of electrification. So are we seeing increase in ordering for the ICE business, and also wouldn't this in turn also result in lower capex for the new EV orders which we are getting? How does it in turn influence our Europe business?
Okay, the EV business in Europe is slowing down slightly during this beginning of the year, of the calendar year 24, mainly because of the let's say elimination of subsidies in certain countries like Germany. Okay, the ICE business is more or less stable. We keep the same let's say sales on the internal combustion engine components. This business remains stable, but the electrification components are a little bit delayed. All the programs are being delayed, and all the car makers are now, OEMs are suffering because of this slower than expected electric vehicle sales. Considering this, however, we see that the future this electrification will come, and we will see these electric vehicles growth in the future, in the near future, but probably slower than we expected 1 or 2 years ago. Regarding the new orders that we are getting in Europe, approximately 40% of the new orders that we got are for electric vehicles. So the evolution and let's say the transition from the internal combustion engine and to the electric vehicle components will happen smoothly, as our let's say new order portfolio are aligned with this transition, and we are increasing our electric vehicle component business. For example, one explanation of the delay of the electrification is happening in Metal Castello too, where we got a very, very important business for the electric vehicles components, gears, especially for the US market, and these programs are not coming yet. Okay, the sales are very, very low. We are far below our expected sales on these components, but let's say the market and all our customers are informing us, are saying us that this transition and this growth of the electric vehicle components will come in the next quarters. So we are ready to start producing these components, but unfortunately the market is not helping us.
Got it. Thanks. I'll fall back into you.
Thank you.
Yeah, thanks, Dinesh.
Thank you. The next question is in line of Nitesh Vege from Chris Capital. Please go ahead.
Audible?
Yeah.
Hi, sir. So I just wanted to know whether we are able to grow our business from our non-anchor customers, customers ex Mahindra, Bajaj, Tata, And if you could just share how much our revenue from non-anchor customers has increased in CY23 and this quarter.
No, Nitish, let me answer this question. We have talked about this in the past about our portfolio approach to our customers, which helps us, de-risk, which helps us maintain our margin. And we have talked about that our anchor customers, which are 4, and we are dividing Mahindra into 2, auto sector and tractors, auto sector and farm equipment sector, as Mahindra calls them, Maruti and Bajaj, which together would be in the range of roughly 50 to 55%. And after that, we have a whole range of customers who are in the range of 3 to 5% of sales, including Tata Motors, Ashok Leyland, Hyundai, Kia, Bosch. There are many, maybe about 10 or 11 customers. And then there is a tail, and then there is a long tail. We have close to about 50 customers in India, over 1 crore. So of course the anchor customers are also growing, and then the focus is on, I told you, those 10, 11 customers, and then they will grow. If you remember, we have always mentioned that we have made significant investments beginning from 21, from calendar year 21, just after COVID. And those investments are backed by orders. It's just that some of the orders, the ramp up has been delayed, which we have explained in some of our earlier calls, especially the orders that we have got for our new plant at CIE Hosur, some of the orders for the EV business at aluminium and at Annettville Forge. So those are delayed, and those are a mix of both anchor and these customers that we are growing. And in fact, we do expect in the second half of this year for some of the orders to ramp back. So to answer your question, I don't have a specific number to report as to how much they have grown, but yes, they are both the anchor customers and that 10, 11 customers that you are talking about are very important for our long-term growth strategy as well as margin strategy.
Okay, thank you so much for that. And the next question is for Ander. Just wanted to understand, are you happy with the India growth? Do you think we could do something better to improve our growth?
Okay. Let's say that we are satisfied how the business and the evolution and the management is doing in our all in Indian verticals. Okay, the growth that we are expecting is higher than the growth that we have shown in the last quarters, but mainly is because of the delay that Vikas explained before. I mean, we had certain big projects with important delays in our customers. It's not our let's say mistake or lack of management. It's due to the delay in the launch of the new projects from our customers, and these launches are happening, and we are already ramping up those projects. So as Vikas said, we expect to show to the market higher growth in the next quarters. Okay, probably by the third and the fourth quarter, let's say by the end of the year, we will see this jump happening finally. Most of these programs are for export programs, and these, that these sometimes there are certain delays on these launches, especially when we are talking about new technologies like electric vehicles or new products that our customers are launching also in India. So my view is that we expect to have better growth in the next future. Okay, and right now we are a little bit above the market, the weighted average market in this moment. The market grew in this quarter approximately 4%. You need to consider that both commercial vehicles and tractor business dropped approximately 15% this quarter, and that means that the average growth of the market is according to our portfolio, is approximately 4%, and our growth is around 6%. So we are a little bit above the market. But you are right that we expect to have a better growth and higher growth in the next quarters.
Nitish, can I add something to that, if you allow me a bit of digression?
Yeah, yes, sir.
Now, when Ander talks about, what is ramping back, like, of course, we are seeing, very good response to the XUV 3XO, where, we have substantial business for stampings and gears. Mahindra is also launching their urban, those small commercial vehicles, 0.8 to 1.5 ton. We are also very hopeful about that. Of course, Mahindra's pure BEV vehicles, but those are for later, maybe not in this year. Then at Bajaj, we are again, Triumph is doing well. So there we are. The CNG bike for Bajaj is again something that we are very much looking forward to. There are a lot of export orders that Ander talked about in electric vehicles. We have talked about the orders for shafts from Bilforge. We have orders at our aluminum business also. Maruti is launching new SUVs. So for our crankshaft business, that's something that we are again looking forward to. Tractors, I think in Mahindra, the K2 series, it is something that again, we think it will do well. And of course, there are a lot of resourcing projects from our existing customers. So no, that's the reason why there has been a delay. Because to answer your question, have we been able to grow both in our anchor customers or beyond? The answer is yes, both in our anchor customers and 10, 11 customers, and that's the reason why I have taken the liberty to talk about some of the models that we are eagerly waiting for. So that will hopefully give you a kind of preview as to why we think we are confident. And it is, as Ander said, it is more a market phenomena that the growth has slowed down, and I will talk about that, and that's why I took your permission for a little bit of digression now. So if you look at the 3-year period from C21 to C23, 3 calendar years, overall our growth is quite good. On an organic basis, we have grown 40% in these 3 years, because that's what I've said. We have been investing a lot. Unfortunately, the growth has been bunched up. And in the last 2-3 quarters, the growth has been less than expected. But overall, this 40% growth on an organic basis compares, very well with what everybody else has done in the market. And we have done a check on, at least 12 to 15 of the players who are in our peer group, and it compares well with that. But over and above that, with this growth of 40% between these 3 years, we have shown perhaps, one of the profit growth on the higher side compared to, if you do a peer benchmarking. So it's not that we have neglected growth or we are not growing or losing share, nothing of that kind. It is just that some of our growth is bunched up. So if you look at this 3-year period, just to buttress the point on the bunching up, I also looked at the India growth performance for the last 6 quarters, starting from Q4 C22, looked at our growth in India and the weighted average growth of the market. Now again, on this weighted average growth, I understand, some of the numbers, at least in this quarter, there is some discrepancy between SIAM and IHS numbers, but be that as it may, like the trend, I will tell you is, how it has bunched up. So if you look at Q4 C22, that is 6 quarters ago, the weighted average growth in India was roughly about 16%. We grew 26% at a recurrent EBITDA margin of 15.5%. In that particular quarter, there was certain one-off. If you look at Q1 C23, the weighted average growth in India was close to -3%. We grew 13%. Our EBITDA margin was 16.7% in India. If you look at Q2 C23, the weighted average growth in the market was roughly about 0.3%, and India operations grew by roughly about 5%. Our margins were 16.8% EBITDA margin. Q3 C23, if you look at it, our weighted average growth in the market was roughly 2%. We grew at 1%, lower than that. The first time we went below the weighted average market growth. Our margins were 16.7%. Q4 C23, the weighted average growth 3.8%, we grew at 4%, so roughly in line with the market. In Q4 C23, our margins were 16.5. Now, if you look at Q1 C24, like we are talking about 4.8, I know there is some discrepancy in data, but anywhere between 4.5 to 5.5% is the weighted average market growth, and we have grown at 6%. So if you clearly look at it, we outperformed the market, say 6, in Q4 C22 and Q1 C23 handsomely. Then Q2 C23 was, somewhat close to the market. Q3 C23, when we went down below, Q4 and Q1 are more or less in line with the market. Q1 is slightly better than Q4. So clearly you see the trajectory is again going back. So, this is the point that I'm trying to demonstrate. It is rather, more because of the bunching up and ramping up of orders. And in fact, as I said, more or less, we are very confident that both growth and margins will be able to deliver on a longer term basis. And this data I'm trying to show you, the bunching up data between C21 to C23 and this last 6 quarters, just to show you that on a longer term basis, we have done well, both on growth as well as margins, and I think this performance will continue. Sorry for this digression, Nitish. Hope that's okay.
Yes, sir. This is quite helpful. Thank you so much for a detailed answer. That's all from my side.
Yeah, thanks, Nitish.
Thank you.
Thank you. The next question is from the line of Sonal Gupta from HSBC Mutual Funds. Please go ahead.
Yeah, hi, good afternoon, and thanks for taking my question. So just wanted to understand, one, is there a sort of reclassification on the other operating income in India? Because, last year we were doing 90 crores plus every quarter. This quarter it's dropped. So is there something of a reclassification into other income?
No. Because if I can take that?
Yeah, only you can take that, JP.
No. So that's because we have started using the scrap generated by stamping within our foundry. So there has been no outside sale and a reuse within the company.
Okay, and the other income partly, like you mentioned, is a 22 crore one-off subsidy, but otherwise also it's slightly on the higher side. So that's interest income, etc. Is that the way to look at it?
Yes.
Okay, and I know we've had a lot of discussion already on the growth aspect, but just coming at it from a sequential standpoint, right? Like all other things being equal, sequentially we've seen good growth across categories, PVs, even MHCVs, tractors also. So I'm just wondering that the sort of 3% QOQ growth that we're seeing for you seems to be again significantly below market. Only two-wheelers were sort of flattish on a production basis QOQ. So just trying to understand, is that because of certain product-specific reasons again, or something of that sort, or what else is explaining this?
Sonal, if you look at sequentially, you are right about that. The difference would be 3% or 6% given that those numbers that you are citing. But within that, like for example, in tractors, the difference say between our portfolio of tractors and the rest is a little worse off in that case. So if you look at it sequentially, say between the Mahindra brand tractors and the Swaraj brand tractors. Similarly, on the two-wheeler side, for example, Bajaj, because of exports, was a little lesser than what you are seeing in terms of that flattish growth sequentially that you're talking about. So it is largely a mix of, the specific customers that we are dealing with on a sequential basis. On year-on-year basis, it has worked differently. On a sequential basis, it has worked differently because of the base effect. I think all these things would just even out if once you look at it on a full year basis. Again, the point being, Sonal, I think it is really the delay in ramp up of orders, which we do think will start happening in the second half of this year, especially in some cases like stampings. XUV 3XO is already doing well. I think 6,000 roughly that 5,000 vehicles, and we expect it to go higher as we go along. So like that sequential thing versus year-on-year thing, it's basically because of that specific customer base that we are targeting.
Got it. And just on this 3XO, I mean, like, would our content be very different from the 300?
No. It is the reworked version. I think if you look at our, the stampings bit is the biggest part of our Mahindra business. So overall, if you look at Mahindra, would be in the range of roughly about, that's in that related party transaction. The number is there, about roughly 1,600, 1,700 crore. About 60% of that is coming through stampings. Stampings and gears are the biggest, beneficiaries of XUV 3XO. So we have good order.
No. Where I'm asking this question is, like, in the case of the Scorpio changeover, we lost content. So in the case of 300 to 3XO changeover, we are gaining content, or we were not there in 300 earlier and we are now getting into.
No, we were there in 300, both in stampings as well as gears, and we are there in 3XO. The Bolero Scorpio thing is more of, like the old Bolero and old Scorpio are very old models. I think the manufacturing philosophy was different, almost 20 years ago when they were, when they hit the market. In 300 and 3XO, there is no such, there's no such change.
Got it. Great. Thank you so much. Thanks for answering.
Thanks, Sonal.
Thank you. The next question is from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. Sir, I have two questions. First is on the XUV 3XO size. So if you can explain, like, how big is the order? And second, on the consolidated basis, if we see Europe, that is still, degrowth side. So when we can expect a good recovery side, or you can say on a profit side. So as you were talking about second half, so is there any certainty on that side, if you can explain? Thank you.
First I'll, answer about your XUV 3XO. Yeah, as I told you, stampings and gears, those are our main, which I guess was also there on XUV 300. It is a rework. It's a much better version of 300. So it is basically stampings and gears, and since it is stampings, as I told you, we have good orders on that. As far as on your consolidated growth question is concerned, I think yes. In India, we have grown 6%, and in Europe, we have dropped by 7%. So overall, we are looking at roughly about 1% growth. As soon as the India growth picks up, and as we also told you, Q1 in Europe looks bad because of the very high base effect in Q1 of last year. So that base effect will also wear off. So you will not have such drastic year-on-year numbers going forward in Europe. But the main thing is the India growth we expect to recover in the second half of the year, and that should drive growth. So on a consolidated basis, you will see an improvement, to answer your question. And just to bolster, I'll request Ander to talk about the prospects of the European, we have talked a lot about India growth in the second half. I'll request Ander to talk about, the prospects in the European market for the coming months.
Yes. In Europe, we see let's say a flattish market in the next quarters. Okay, the expectation for the car sales in Europe is about the total figure is about 17 million cars will be produced during this calendar year. So this is a drop of 2-3% compared to the previous year. So we think that we will have a flat year, but as Vikas said, let's say that the comparison in Q1 23 was very high. I mean, because that was the last strong quarter in Europe. Then we saw a certain decline during the next quarters. so the base will be different in the next quarter, so we will not be affected so much. But I would like also to reinforce certain message on India, okay? Because the reality is that we are not concerned about our growth. I mean, the new order book last year was really good, and we fulfilled our targets. Additionally, this first quarter, we already got additional new orders in India of above 3 billion rupees per year more for the next years. And what we are doing now is we are adding capacity and we are expanding our plants in most of the verticals, okay? In the composites, in stampings, in forgings, we are adding capacity and we are, let's say, expanding our plants to be ready for the growth that is coming. So, in my opinion, this is just a temporary situation that we are having because of the main project that we launched in the last years, especially in the Hosur plant in Belfort. This is a little bit below our expectations. Once the customers come, we will see an important jump, and we will see that we are at the same level or even better than our peers. Okay, so that's the view that we have on the market, and of course we continue working in let's say in a very strong way to continue our growth history in India.
Okay, thank you so much, sir. And sir, last, if you can guide us on the capex side for the CY24.
Okay, the capex in our, let's say, you know that our guide is to have approximately 5% over turnover, I mean, over the sales. 5%, this is the figure that we consider reasonable and very sound. In the first quarter, we had the capex we spent was almost 1 billion rupees. This is a little bit less than 5%. I mean, we are at 4.2, 4.3% over sales. But in the next quarters, we will recover because some additional capex is coming. So we can say that 5% is the average where we are comfortable. And if we, let's say, make the split between Europe and India, all the growth capex is concentrated mainly in India. Okay, so the growth at the capex is higher in India rather than in Europe.
Thank you so much.
Yeah, thanks, Jyoti.
Thank you.
Thank you. The next question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Yeah, hi and good afternoon. Sir, on the capex again, I mean, can you highlight are these new orders that we have won that we have to put this capex for? I mean, how are we positioning this capex?
So, Andrew, the question is, where is the capex in India going? In which businesses?
Okay. No, I think in all the verticals we are growing, so we are adding capacity in all the verticals. Okay, if we let's say make a deeper analysis on that, our composite business is growing importantly. So this year we are growing around between 20 and 30% of growth in the composite business. So we are expanding, we are building a new plant and the new shed and a new machinery. So that is part of our capex. Also in the stamping plant, we are adding one new press line that will be ready for the start of production by July approximately. That's why we expect also a jump in the second half in the stamping division. In the forging plant, we are also expanding our plant to add a new crankshaft machining line. So this is an additional investment that we are doing. So in the gears division, we are also we have finalized a new office building in order to let's say have additional free space in the production plant to continue our growth history, and we are also planning to invest in more capacity, especially in the high added value technologies like gear grinding and this kind of technologies. So those are some of the examples of the different projects that we are now investing for, and we expect to be ready during the second half of the year. So on top of that, the new programs that we are getting from the customers will require additional capex. So let's say the business continues growing and continues the normal evolution.
Okay, sure. And so in India, we have a large tail of customers where, I mean, the contribution from them is not much, and even our wallet share there is not high. So, what is our focus in terms of this long tail that we have, and what kind of conversations are we having with them, and what does it take to ramp this up to a respectable or a larger number?
No, as I said, it is not about the long tail. It's about those 10, 11 customers in between that I talked to you about, in the initial part of the conversation. Like we are talking about Tata Motors, Ashok Leyland, Hyundai, Kia, John Deere, those kind of people, those, we are trying to grow. What it takes, it takes some time before you grow with them because, once they are convinced about your abilities, they start growing with you. And the rest, as and when, we have a foot in the door, beyond that, we have a foot in the door, and whenever they want to grow with us, we are happy because the kind of customer base that we have in India is very varied and diverse. I don't think there are, lot of examples of this kind. So what does it take? Of course, it takes, working with them over a long period of time to get that going.
Correct. And Viraj, you've been, talking about acquiring this plastic business inorganically for a while, but obviously the valuations don't match. Any possibility that we can try and think and do this internally, build it out organically?
No, organic, the question is, do we have the capabilities? Does CIE have the capabilities to build a greenfield plastic plant? The answer is yes, very clearly yes. They have plants across the world, so CIE can help us put it there. But it's not about putting a plant. In a B2B business, specifically of the kind that we are, manufacturing B2B business, I think having good anchor customers is very important for that business, and that's the reason why we thought that inorganic is the best way to go. Of course, as you rightly pointed out, inorganic is a 0-1 situation. So it is not always, not in our hands whether we can do that or not do that. But the issue is getting an anchor customer. I'll give you an example. When we wanted to get into aluminium, we got our aluminium business at that time called Aurangabad Electrical, and then we got a strategic customer in Bajaj. So, and if we had tried to build that over a period of time, it would have taken a much longer time than what it would take through through the inorganic route. So there are advantages, disadvantages, but yes, for plastics, given that in India we don't have any plastics business, we still think M&A is the best way to proceed. But of course, as you rightly pointed out, M&A has its, conditions, and let's see about that.
Correct. And so my last question on margins. I believe currently there would be some cost which would be sitting given the lack of or delay in ramp up, be it India or even Europe. Is it something substantial? And also if you can talk about this, the end target is this 19% which we intend to do, and we've been doing 17 for a while now. So this journey from 17 to 19 also, with some comments if you can share.
No, as I was demonstrating, when I was talking about the quarterly numbers, so if you look at, again, the India quarterly EBITDA margins, I'll repeat that. So in Q4 C22, we were 15.5. And then, we have been, and in this quarter, we are ending at 17.2. These are all recurrent numbers without any one-off that we are talking about. So we have gone from 15.5 to 17.2. So that's an increase of 1.7 percentage on a very high base. Given we are a diversified portfolio, it is not just machining where you get higher EBITDA. 1.7% in a matter of 6 quarters. So that steady improvement will continue. Of course, in Europe this time you are seeing a lower margin because of the stock correction, lower than, it probably would have been lower because of lower sales, but you're also seeing that because of stock correction. So overall, Europe has been a little depressed in this quarter, but India has crossed 17% EBITDA margin for the first time. The way we calculate, I understand some of the colleagues on the call, they do it differently, but I'm saying from whatever we present, for the first time we have crossed 17% in India. In a very, very diversified portfolio, including things like stampings and iron castings and aluminum castings. So this performance, which we think is very creditable, will continue. But it will be, slow and steady improvement. You're not going to see step jumps in profitability improvement. To your other question, because there have been some delays in ramp up, some cost will be sitting. The answer is we understand this is the nature of our business. So we'll have to learn to tide over some of those things, and that is what we are trying to do. Does some extra cost sit during periods when capacity is less utilized? The answer is yes, but then that is the nature of our business. It's a B2B business. Some models work, some models don't, some models are delayed, some models are not. So that is something we have to find a way to deal with it. So that's what we are doing. Hopefully that answers the question.
Sir, the line for the current participant has been disconnected. We will move on to the next participant.
Yeah.
The next question is from the line of Bharat Seth from Quest Investment. Please go ahead.
Yeah, hello. Am I audible?
Yes, Bharat bhai, go ahead.
Thanks for the opportunity. So Vikas, just on coming to first question is on the margin in the Europe. As you rightly said that because of price correction, and so how do we see for rest of the year? I mean, Europe margin and for the full year again bouncing back to same last year level.
Ender, can I request you to take this? What is the prospect on European margins?
Yes. No, what we see is that in the next quarters we will see, let's say, a flat market, and as you explained in the script, because the drop of this margin in the first quarters was mainly because of the Easter holiday that happened at the end of March. So we reduced our production. So we had a certain decline in the production in this quarter because of this holiday week. Then we think that in the next quarters, despite the market will not be fantastic and there will be no big growth, but we will recover, and we are in line to recover the margins that we had last year. Okay, so we don't see any reason to lose that. I mean, if everything goes as it goes now with the energy prices under control and raw material prices under control, we think that our margins will be at the same level than last year. So we don't see any reason to reduce the margins. Unfortunately, we don't see either growth or ramp up on the sales, mainly because of also Metal Castello's market is negatively affected by the American-US market evolution during this year, and we expect this recovery to happen during next calendar year or at the end of this year.
Right. And now with say infusion of the capital into this our Billforge Mexico entity, so do we have any plan to ramp up or additional? And if you can give some color on the performance of that Billforge Mexican entity.
Yes. Yes, that entity is also growing. We are now producing at a, let's say, at a higher pace than the previous quarters. And you know that we are producing CV joint components for different customers, and the expectations are good for the near future. The company, let's say, we had big projects for the electric vehicles also in Dilfort, Mexico, and those projects has been a little bit delayed in the U.S. market also. So that's the reason our growth was lower than expected. But right now the company is performing well and is growing. So you will see in the next quarters how this company continues this trend. We are above $3 million of sales per month in that company. So we are at the levels that we were expecting when we launched the plant. So we will be close to $40 million in the calendar year 24.
And going and EBITDA side, margin perspective, EBITDA margin perspective.
So EBITDA margins in this business, we have been affected because of the huge raw material price increase that we had in the last years, and also because of the American market. The USMCA market is protected from the raw material point of view. The steel prices are really high. Okay, that's means, or the effect of this is that unfortunately the margins we grow, but the margins are lower. So we can be between 10 to 15% of EBITDA margins in those businesses.
Great. And last question on Indian entity. We have done some restructuring on the management level. We have elevated a two division CEO. So how do we read that, and what is the purpose of that?
Okay, the purpose of that is to structure properly the company to prepare the organization for the growth in the next years. Okay, what we did is we reinforce our main or the best managers and the best executives that we have. The CEO position for the different verticals. So we assured also our succession plan for the future, and we also motivate them to continue growing as they did it till now. Okay, so the strategy is to reinforce the growth, to reinforce the team, and to prepare the organization for the future, and to have a proper succession plan in place.
Thank you very much, and all the best.
Thanks, Bharat bhai.
Thank you.
Thank you. A reminder to all participants to please press star and 1 to ask question. The next question is from the line of Sriram, an individual investor. Please go ahead.
Yeah, thanks for the opportunity. Can you share the revenue breakup in terms of power source, like how much would be IC, EV, and power source neutral? Also, how much of your business is dependent on ICE? I mean, like when the transition happens from ICE to EV, what would be the impact in terms of revenue?
Let me take that. In India, of course, overall will be 20% or thereabout, or even lesser than that. In Europe, of course, we have two major businesses. I think if you look at it roughly, we are 350 million euros, out of which say about 65-70 million is metal cast alloy, and the rest is forgings. So in that forging business, crankshafts are a substantial part, because we are one of the most important manufacturers of crankshafts in Europe. So in Europe, that dependence is higher, but then we are among the main players of crankshaft. So the way to look at it, Sriram, is like this. Depending on the transition. So for example, in India, if you are talking about 20%, we were about 5,500 crores in C23. And if you look at 20%, you're talking about somewhere 1,000-1,100 crores dependence on ICE, out of which say 60% will be four-wheelers and 40% will be two-wheelers. So the pace of transition will be very different between four-wheelers and two-wheelers as you look at it. And therefore, and even if you look at the value at risk that we are talking about, we might be expecting not say roughly say 25-30% penetration in the next 5 years for two-wheelers and maybe 7 to 10% for four-wheelers going forward. So if you do a value at risk, it is not very high. You're talking about less than 500 crores value at risk, maybe 3-4 years down the line. And that, that is something that anyway we replace every year. As you might be aware, almost 10 to 15% of our business gets replaced, obsolete, whatever is. So really there is not much risk in India, and that's the reason why we keep talking about this being more of an opportunity rather than a risk. In Europe, as Ander has pointed out repeatedly, I think because we are main players in crankshafts, when the EV transition happens, of course, there will be some effect in Europe, and that's the reason why we are preparing. He talked about how 60% of the new order book in Europe is EVs. We have got, very important orders at Metal Castello for EV transmission parts, for aluminum forgings, for steel forgings, for batteries, etc. So we have enough orders to cover any transition in the European market. So, but there again, you might be aware that the European EV penetration is also slowing down. In fact, on a YTD to YTD basis, Jan to March, I think battery electric vehicles have lost a percentage point in terms of penetration. In fact, hybrids have gone up by 5%, EVs have come down by 1%, and petrol and diesel both have come down by 2% each. If you look at the RCR data, and they have a very good database. So the question is the EV, penetration in Europe is also slowing down, and in India it is very specific to some segments. So I don't think there is much of a risk in India. It is more of an opportunity as we get newer and newer orders. As we told you, in India, for example, we have orders for shafts in our forgings business. We have orders in the aluminum space. We have large orders in the composite space for three-wheeler EVs. So we have a whole set of orders which, once it starts ramping up, we are very well prepared in India to take advantage of that opportunity. In Europe, I think it will be more of transitioning from ICE to EV as and when it happens. But so I think we think we have a good strategy in place as far as EVs is concerned, and we'll manage. Rather, we see that as an opportunity actually.
Okay, so thanks for that elaborate answer. But how would the pie shrink? I mean, in terms of content per vehicle, how would that change?
Look, it's as simple as that. You are looking at it at a macro level. I am looking at it from my company's perspective. So, like as I said, if I have my value at risk is 500 crores, so I have to cover that 500 crores and I have to grow beyond that. Yes, when it comes to shrinking or whatever, that much as and when EVs become more mainstream, you'll have more data. But roughly 65% of EVs are agnostic to, like for example, our stampings business, our composites business, our gears business. They won't be affected by this transition. In fact, they will have more opportunities. They fall in that 65% space. But you have a 35% engine cost, which obviously will change. The nature of that will change. Right now, in an ICE engine, we use a lot of forgings, we use a lot of castings and machine parts. But when you go to battery, it will be something else. For example, a lot of aluminum will be used, and that is what, we have orders in our aluminum business in India. Those are for, as Tata indigenizes their power, their battery, the batteries in India. I think we are getting, orders in that system. But in aluminum, which right now will be in forgings. Being a diversified maker, especially in India, we don't have that much of a problem from the question that you are asking.
Okay. So that answers my question. So thank you so much.
Yeah, thanks, Sriram.
Thank you. The next question is from the line of Jitendra Khatri from Tata Mutual Funds. Please go ahead.
Yeah, thank you. So my question is, what's your thought on this new concept called giga castings? We hear of it everywhere, Tesla, BYD trying it.
No, that's for OEMs to worry about. We are part makers,
Yeah.
Look, giga casting is a way of making the bodies of the vehicles. And as and when as it becomes more mainstream, we'll see, because we are not involved in that process. We, even in our stampings business, we make the B class and C class stampings, which go, say, for in the door assembly or something like that. You'll still require all of that. So, yes, it's an interesting concept, but, as of now, we don't see how it is going to affect our kind of parts. But to understand more, I'll refer to Ander if he has something more to add on this technology.
No, you answered properly, because these technologies are more orientated to the OEMs. Okay, they produce the OEMs, the big OEMs, like the Tesla was the first OEM to introduce this concept of giga casting, but they invest and they produce the components internally, because those components are so big that cannot be transferred or transported from a supplier to the OEM. So you need to be close to the factory. This is a first concept. So we don't see suppliers developing this, because this not possibility of transporting these components requires that the production is done in their own facilities. Also, we think that the investment on these technologies is huge. I mean, it's very, very important investment, and for us, it would be a big risk to accomplish that. So we are not considering the giga casting. We think that this is a business for other kind of producers, mainly OEMs.
Thank you. Thank you very much.
Thank you.
Thank you. The next question is from the line of Bharat Seth from Quest Investment. Please go ahead.
Hi. Thanks for the opportunity. We were talking of developing a aluminum forging. So any update on that?
Under aluminum forge in Europe, any update?
No, we continue with our strategy of developing this technology. We have already invested, and we are producing certain components, and we continue developing the business with our customers. There's no news, no different news than additional news from our last quarter comments that we did. So we continue, the ramp up is there, and that's the strategy to continue expanding this technology in the future, that we expect to grow further. And also we are working in different steel forging components mainly for the battery pack. Okay, so we are working on that. We are launching a big project with one of our main customers in Europe. So we continue diversifying the products, entering into different components, and preparing the transition to the new era that is coming in the future.
So when do we expect, to start, a kind of a noticeable or good part of the revenue from this business?
We think that we were expecting certain growth during these years, in the next 2-3 calendar years. But as explained before, the electrification process is slowing down in Europe in this moment. The new Euro 7 norms that will be applied by the European Commission will or has been delayed until mid of 2027. That means that the internal combustion engines and the standard cars will continue being produced in this period, and we will see a delay on the electrification process. That's our expectation. So we think that it will take some years to come, probably 4 or 5 years to see certain growth on these new components, because the trend in Europe in this moment is that let's say the current situation, the electrification will slow down a little bit from the previous growth that we had in the last years.
Okay, thanks for the reply.
Yep.
Hello. Thank you.
Yeah, thanks, Bharat.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Okay, so thank you everybody for your good questions and well-directed questions and your interest in our company. I hope we answered properly and you had the good impression of our evolution as a company. So thank you everybody, and thank you to all CIE India members because of the great job that they are doing in the company. So thank you and see you next time.
On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Yeah, thanks. Thanks, Utan. Have a good day, guys.
Thank
Bye.
you. Thank you. Have a good day.